Good morning. Welcome to Forex.Today. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com. That's me. We do these sessions 7:30 in the morning, Monday through Thursday here at Forex.Today, and every Friday at FX Street. Is it Thursday today? I think it is Thursday, right? Yeah. I have class tonight. So, TradersWay gives you access to the Forex market. It's what I use. I hope you join with me. Let me remind you that trading Forex is risky, not appropriate for everyone. Past performance, good or bad, is not necessarily indicative of future results. But please always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. You know what I don't have running at the moment? I'm just so distracted. Is the TV. Let me turn the TV on. So I wonder what the fat heads are saying, huh? So yeah, a lot going on. The markets are moving, which is good. Just a few minutes ago, there was a rumor hitting the market that the Bank of Japan is going to intervene, or trying to intervene, or did intervene. I hate situations like this, to be honest with you, because I don't like rumors. I like facts. But what did happen in a lot of yen pairs is that you get a giant spike, pullback, and what am I obligated to do? Required by the laws of nature. Trade it. You know, I'm mentoring a guy right now, and you know, I think it was a couple of times last week. He's like, as I'm mentoring it, I traded. He's like, whoa, why'd you do that? Like, tell me, you know, like the deep internal thought process, Wayne. You know, what made you pull the trigger on that? I'm like, I had to. Like, I didn't even realize I was doing it. It was just, there was a breakout, a pullback, and I took it. I don't even know what currency pair it is. I don't know, but I'm like required by the laws of nature. It's like, I'm a trader. That was a trade I had, so I traded it, and I don't even know what I'm doing. So sometimes when you get these big moves, you want to take the shot, especially if it's in the direction that you're hoping to be. Like if you're fundamentally bullish and you get a bullish break, you trade it. But then what I've found over the history of the last 1,000 years of me trading is that rumors are just that. They're rumors, and very often they're false. And so what I like to do is try to play like the rumor's true, but jam my stop. Like I'm not joking. Like I'm up 12 pips profit, jam the stop, just jam it, because there's a huge probability that the idiots that created the rumor are actual idiots. So, but if they give me a proper setup, take the shot, right? And then just remove the risk as fast as you possibly can remove the risk. Cool? Windows 10 wants to update. Everyone wants to update. Apparently 110 million people want to upgrade, but I don't want to upgrade, so leave me alone. I bought a laptop a couple of months ago, and I'm going through the welcome setup. First thing you have to do is create a what was it, an Outlook account or something? I'm like, you got to be kidding me! I bought a laptop and now I have to create an Outlook account. I hate that. That just drives me batty. Just drives me absolutely totally insane. You can't use this laptop until you open up a, what is it, a Chromebook now? At least I had Google before. All right, so anyways, what am I talking about? Let's go into, let's start with Euro USD. Everyone loves to trade it. What? Where's my Bloomberg? Come on, Bloomberg. There you go. Gives you some pretty colors to look at. So yeah, so Yellen is coming up a little bit later, right? The thing is, the testimony is the same. The Q&A might be different. I don't expect her to really change anything, so I don't think we're going to learn anything new. Um, but whatever. No, but right. So let me ask you something. Do you think a central banker, in particular one that sort of governs the entire global economy, is going to come out and say, you know what, we're wrong. We were wrong. We made a mistake, right? Because if you were hanging with me a year ago, I said that there was absolutely no reason for the Fed to raise interest rates in 2015, in like January, right? And they're like, hey, is the Fed going to raise? Because remember, the Fed was supposed to raise interest rates in February. And I said, well, there's absolutely no reason. There's no way in hell they're going to do it. And they didn't. Then they said, well, then it's got to be the one at the end of March. And then it was the one in June. It has to be June. It has to be June. It has to be June. It wasn't June. And I kept saying, well, there's no reason. I don't think they're going to raise interest rates at all in 2015. And then somewhere like in the summertime, was it Jackson Hole? No, it was later than Jackson Hole. Somewhere like June or July, she said, no, the Fed will raise interest rates in 2015. I'm like, oh, all right, so it's the December meeting. And then my tone changed. I said, all right, the Fed said they were going to raise interest rates, so they're going to raise interest rates, but there's no need to do it now, so it'll be the last meeting, right? But if it wasn't for Janet Yellen actually saying they were going to raise interest rates, I'd still be kind of in the tone of there's absolutely no reason why they should raise interest rates. Was anyone trading, 10 years ago? There, I don't know if it was nine or 10 years ago, but there was a time when Japan started to develop inflation and they raised interest rates. Japan actually raised interest rates. Right? How many of you guys actually seen Japan raise interest rates, right? They raised interest rates by a whopping, 0.25%. And what happened? 0.25% doesn't mean anything, right? What's the big deal, right? You know what happened? The entire economy collapsed. Whoops. And these were the guys that invented quantitative easing. Wouldn't it be funny for the Fed to come in, do quantitative easing, and then make amateur hour mistake, raise interest rates for some esoteric ivory tower academic model BS? Right? Oh, the Phillips curve, the Phillips curve. Shut your mouth. And so here's maybe a fundamental flaw. I didn't mean to get into this today, but I haven't slept much in the last 3 days. My brain's shut. That there needs to be a change in central banking modeling, because here's what happens, and it's unbelievable how amateur it is, but let's talk about it. The Fed sits in a little room and says, what's going on in the United States? And the ECB sits in their little room and, what's going on in Europe, right? And then Japan sits in their little room, what's going on in Japan, right? So on and so forth. Bank of England, right? And they're all off on their own. And aren't they mature enough to understand that it's a global economy? You know what I mean? Like they don't get right. Like, well, according to the Phillips curve, if you look at the GDP relative to the blah 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 blah, are you only looking at us? My God, Europe's in absolute total decline and depression. Why would you jack up interest rates? Oh, well, the Phillips curve says the relationship to this to the relationship of that, and blah, 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 blah. What? Now, the only maybe caveat to that is that the United States of America is the world's largest economy, and by far. 70% of it is local, right? When we talk about 70% of the United States economy is consumer, that means 70% of the economy could just, the United States could basically live by itself. But that doesn't mean you maybe should be raising interest rates at this point, right? I would rather have high inflation. I'd rather just make every American filthy, stinking rich. Housing prices quadruple again. So what? So when we were caught in horrible, horrible inflation in the what was it, 70s, late 70s, early 80s, we had been in horrible inflation for like 10 years, and it got to the point where mortgages were 20%. Do you know how long it took to stop that, to completely end it? I'll give you 1 point if you get that answer right, and a bonus point if you told me who did it. And a super extra bonus point if you're less than 20 years old. Because Joseph has a gray beard. He should know this. Reagan, come on, Daniel. Like a president had anything to do with the economy. Come on, Daniel. Vey. Presidents do one thing, they ruin the economies. Volcker, all right. Volcker gets a point for who did it. John, are you under the age of 20? Shoot, are you under the age of 30? All right, then you're supposed to get that one. All right, so John gets 1 point. Now, how long did it take? I'll be very flexible on your answer here. How long did it take Paul Volcker to crush inflation? And I'm counting in like years here. The unit of measurement is years. Daniel's going with 4. Anybody else? There's like 100 people in the room and like 3 people chatting. 10? 10? I'm looking for 2. If you said 2 or 1, 3, I think it was faster than 3, but 3 is closest right now. So, Oren throws in a 1. So I'm looking for 2. So Izzy gets it. So what's the problem? Let's have some super ripper awesome inflation. We have none now, so what's the big deal, right? Ask Japan how difficult it is to create inflation in a deflationary market, right? So let's create some inflation. Don't jack up interest rates. So we did the quantitative easing, but why don't we have a major result of that? Well, the stock market was up like 150% from the bottom. That's a good start. Huh? Oh, but besides that, well, people are making profit on their house as long as they weren't broke before. If you were broke before the economy crashed, then you're still broke. But if you were rich before the economy and survived, then you're doing all right again, right? You drive around my neighborhood and everyone's putting in new pools. One person's ripping out an old pool to put in a new pool. I'm like, who does that? So anyways, yeah, so I think the central bank should get together and say, well, the external risks are important and we shouldn't raise interest rates unless we are being crushed by inflation or Europe starts showing signs of coming back to life and that Europeans are playing well with others, right? Yeah, could be it, Richard. Could be it. So, my trade's still alive? Yeah. Yeah. All right, fine. So, Euro, going back to Euro. Oh man, I missed a point. I had a good point. I got off track there. Um, well, let's go into the facts, Jack. We were talking central banking policy and raising rates. So why don't we go to Fed Watch? Is it here? At least put the proper name on it. All right. Okay, you want some facts, guys? What are the odds the Fed is going to raise interest rates at the next meeting? Zero. Probability of a rate hike? Zero. Negative zero. Warren's closest. Whoa! What? All right. April's meeting. Remember, no press conference in April. 2%. So 98% chance of doing nothing. That's pretty high. All right. All right, June. June's the big meeting, right? Got to get the rate in there, hike up interest rates before going into summer, right? June is 5% chance that they raise. Woo. What happens in July? Nothing. No one does anything in July. So skip to September. All right, in September, there's an 8% chance of an interest rate hike. Wow. No, okay, Richard's talking about negative interest rates. It's negative deposit rates. Do you understand the difference? Anybody get confused with interest rates and deposit rates? Should I spend like a second on that? Hey, how did it go, Ryan? Did you send me an email? I haven't even checked my email or anything. Do we have our band of brothers or what? No. They're all sitting in one chair around one book. All right, so all right, hang on. Let's use this. Ciao. All right, you're a bank manager now. You guys ready for this? Commercial bank. Okay? So you're a bank now. What's your job? What does a bank do? Bank takes deposits. Okay. Assets. How do you guys get me into this stuff? Balance sheets, right? Liabilities. You take in a certain amount of deposits. It's a liability. Why is it a liability to the bank if you have $100 million in cash? Because you owe your clients the money. They can come in, it's a demand deposit. Give me my money. Give me some of my money. Give it to me now. I'm waiting, right? So it's a liability. The bank owes it to their clients, okay? Okay. So now let's talk about the asset side. You have required reserves. And in the United States, required reserves are 10%, otherwise known as the reserve requirement ratio. What does that mean? So, a client comes in, deposits $1 million. You have $1 million in cash as a liability. 10% is required to be held at the central bank. So $100,000 must be deposited, let's say, at the Fed. Okay? You get it? What do you do with the other 900,000? You loan it out. So in Europe, banks don't lend to people. Banks don't lend to companies. They don't do anything with it. They're slow, right? There's like 5 entrepreneurial cities in all of Europe. That's the problem, right? So you just have a bunch of old companies with a bunch of old men and a bunch of banks, and they all sit around and stare at each other. But the idea is you're supposed to make loans, and that spurs the economy and growth and entrepreneurialism and new ideas and new technology and new industry. But Europe's trying. I mean, come on, right? But they're a little stodgy. So they have a couple of choices here. They could buy, let's say, some bonds instead of loaning out, right? They could buy some bonds, put some money here. They can make some loans, put some money here. And whatever's left over are excess reserves, otherwise known as E. The other way you can denote this is required reserves and excess reserves, right? RR plus ER is the difference of required reserves, right? Deposits minus required reserves, minus bonds, minus loans, and anything left over are excess reserves, right? So this is the X factor. This minus this, this, and this is ER. And where do the required reserves and excess reserves that are ready to, you can do whatever you want as a bank. It's a bank manager's prerogative, or buy bonds. They have to buy treasuries, right? U.S. treasuries, treasuries from the ECB, Bank of England, that kind of stuff, right? So they can buy some bonds, or they can make some loans, or they can just have some cash laying around in case there's an unusually large withdrawal. Because let's say a big client comes in and withdraws a lot of money, now you're going to be forced to sell something to cover that withdrawal. Are you going to sell your loans? You don't want to sell your loans, right? Because your loans might be for 10 years, and that loan might be at 5%. 5%? Is your bond paying you 5%? Hell no. You're lucky to get 1 or 2%, right? So you're not going to sell your loans. Plus, these are long-term loans. So maybe you could sell a bond, but if you don't hold the maturity, you could take a capital loss on it, right? So to protect yourself, you want to keep a little bit of extra cash laying around just in case, right? Consider it an insurance policy. Or maybe you plan on buying something tomorrow, So now you have this cash. You know, you've sold a bond. Now it's cash, and you're going to do something with it tomorrow. Either way, it's left over. So what do you do with these reserves? What does a commercial bank do? Where does it actually sit? It doesn't sit in the bank vault. It goes to the central bank. So the central bank now, central bank, and they also have a balance sheet, right? So now they have assets, liabilities. They also have depositors, right? They have from this bank, right? We'll call it bank number 2. I'm just making it up a number. So bank number 2 has a deposit here, B2. Has a parks their required reserves because it's required. But they also have some cash left over, right? So they're going to park some excess reserves there. Now they could spend it, and they'll spend just like you would spend it. You'd write a check or use your ATM card, and not a credit card, right? ATM card or a check. Then you could spend this money all you want. This required reserves are like savings, or it's like locking it up in a CD. You can't spend it. It's required to be there. Okay. So, are you paying your clients interest rates? These deposits here at your bank. Right? The answer is yes, of course. It might not be a lot of money right now, but I remember I used to make something like, I think it was like, I'm guessing 15 or 20,000 a year on interest on my PayPal account. Now, granted, I had like $250,000 in my PayPal account, but they were paying me interest. I'm not earning that kind of money now at all. But anyways, you as a bank manager, you pay interest on these deposits to your clients so that you could park some required reserves at the central bank and then go make loans. And maybe you're paying your client 1%, but you're loaning it out at 6%, right? So you're short the cash, you're long the loans, and you're collecting the spread. Well, so these deposit rates that we're talking about now are affecting excess reserves. Okay? Excess reserves parked at the central bank. The Fed right now is paying money. The ECB is currently charging money. And historically, there usually is nothing. So 10 years ago, 20 years ago, 30 years ago, if you were a commercial bank and you had some excess reserves parked at the Fed, they didn't pay any interest rates. They're just like, it was like a service. That's it. They didn't pay you anything. Then when the financial system crashed, we were worried about interest rates going negative. Not by design of the Fed, but simply because it was the end of capitalism as we knew it. So if you knew you could get 0.25% at the Fed, then that would be the floor. Do you understand? Because you wouldn't buy, as a commercial bank, you wouldn't buy a bond that paid you less than 0.25% when if you just parked it at the Fed, you'd earn 0.25%. So that created a floor. That's why for only like one day did very short-term interest rates drop to a negative, and it popped right back up because the Fed created a floor. They decided to pay an interest rates on these ERs. So therefore that created a floor, and we protected the market from crashing even farther. Now, why does Japan and why does the ECB, right? Why does maybe even like Switzerland, for example? Switzerland's doing it for a different reason, but So let's just talk about Japan and the ECB, the BOJ and the ECB. Why are they now charging commercial banks interest rates to hold their money for them? Because what they're trying to do is say, don't park ER at the central bank. Make loans. And what does this do? It increases the velocity of money. And I'm not going to get into the velocity of money and start giving you formulas and stuff. But the concern now is there's money in the market in the United States. There's money in the market and going to be, the money supply is going to continue to grow for years in the European Union. But who cares if the velocity of money is falling? So they're trying to increase the velocity of money by forcing it out of excess reserves and into the system. And then once it's in the system, hopefully people start spending. Now, what would they spend their money on? Well, what happened in the United States when quantitative easing was created? Well, the stock market went up 150%. So this is why I was telling you, the quantitative easing by design is to increase asset prices. Okay, that's what it does. So if the ECB in March decides to add more quantitative easing, right, then buy the DAX. Okay. Yeah, well, these central banks are not doing enough, and the Fed is maybe doing too much. And what it does is it's a risk-off scenario. People are deleveraging and going back to cash. Okay. So let's move on to a different subject. Oil. But anyways, I just wanted to point out how the market feels about the Fed, what's going on. If you watch this, maybe you should watch it once a day. If these numbers start going up, like I'd probably watch the June one. If this goes from 5% to 15%, dollar will be strong because it's a change in sentiment. Okay, oil. I want to show you something cool. In fact, I haven't even done this for myself, so I'm looking forward to seeing it. Do you guys remember, I don't know, a month ago, I showed you a very interesting fact, and I think it was the first time I'd ever seen it. And you know me, I'm 1,000 years old, right? I'm old, man. Right? I saw Buddha at my high school reunion. That's how old I am. I'm 5,000 years old, right? Um, I don't believe I ever saw Brent and West Texas Intermediate the same price. Last month I showed you WTI and Brent were exactly the same price. It's really strange. Do you guys remember me doing that? Yeah, and I'm like, I've never seen this. It's like, I don't know what to make of it. It's weird. Okay, check it out. Brent, $30.56. WTI, $28.61. Oh, snap. Something happened, huh? Interesting, huh? What does it all mean, Basel? Well, first of all, that's you're supposed to have a spread, but there's yeah, the U.S. is pumping oil into the market. So the big question now that we're $26 a barrel, holy smokes, because it was lower for a while, wasn't it? By the way, this is the cash price. I think the futures price is even lower. Oh, too bad. Baltic Dry Index did not make an all-time low today, but it did tie the record, but no new record. Too bad. So sad. But we have Canadian news. Is it coming out? Yeah, we got a few minutes. But yeah, so I think futures prices are even lower, right? 26.50. Thank you, Guy. Interesting, right? But nonetheless, oil's still down. Oh, see, you'll see. So what should we do? USD CAD? Du, 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 du. Oh, snap. Is that Canadian dollar falling? Weibo! So is it this weekend that the Saudis and the Russians are going to get together? So what we need is a few things, if you don't mind me putting, stringing the pearls for you. We need OPEC, or even who cares about OPEC? Even just let's say Russia and Saudi Arabia get together and they say, all right, enough's enough. We're going to cut production. And then the Fed says we're going to raise interest rates. And then the ECB says we are going to increase the amount of quantitative easing. If we get all those three things, we'll get a change in trend. And I think the probability of all those three things happening soon are pretty low, huh? So trade what you see, not what you think. Okay, that's all. It's weird though, huh? Being what, $28 a barrel? So the only big question mark here is what Japan is doing or maybe doing or what people think Japan's doing. I have no clarity on that. So I need more facts, and right now I have no facts. I'm just reading some news here. So yeah, so I don't know what's going on, but the yen did weaken about what, an hour ago or so based on a rumor. So I traded it. I've jammed my stop, and I don't know. Yeah, Joseph, we're down to, I think it was 168 is what I saw yesterday. Just on that note, I was reading, I know, I love it, right? A government report yesterday on gas prices, actually, gasoline prices, not gas, but gasoline prices, and the current 1 month average is the lowest in the United States since 2004. Isn't that interesting? We're at 2004 prices. So we got Canadian New housing price index coming out. I wouldn't expect much out of it, but it's something. This is a weird one to play. So when you look at this, do you see a trend? Neither do I. So go to like a 15-minute chart, and that's better, isn't it? All right, so where's the resistance? Oops. Buck 40. I'm gonna do another one down here. What do you think of that weekly pivot point? Pretty amazing, huh? Excuse me. And then now on the hourly, let me zoom in. Look at the kickoff, the hourly 21. Okay. So I think the way that people are probably playing this is sort of like in this mode. We got to get through the psychological level of 140, but then I think that puts us on the free and clear plan to get us to 150 or 160, who knows, right? 618 was the bounce. That predicts a 1382 extension. That gets us to not even quite 141, but it gets us through anyways. Okay, if you're a bull. And you probably have it marked up here. Let's connect the dots. You know, we could probably T-bone this instead. Huh? What the fork? Yeah. All right. About 4 minutes now. Oh, as of right now, reportedly, Japan government officials have no comment on whether any currency intervention occurred today. No comment. A no would have been fine. It's one of those things, huh? No, no means yes. Okay, just 3 minutes now to the news. Wonder what's going to happen next week when China comes back to the market. You guys thinking about that? Oh, well, it's only money, Joseph. It's only money. Yeah, probably a gap. It's in a buy zone right now on the weekly chart, but it hasn't moved obviously since markets have been closed all week. It'll be interesting where we find ourselves. They do it 3 times a year, Ryan.
December expected 0.2%.
Well, when there's holidays, you spend money, right?
Because initial jobless claims, 2 seconds. 269,000 below the 280,000 expected for initial jobless claims. Continuing claims 2.24 million, a little above the 2.25 million expectation. Private slightly higher to 2.26 million. New housing price index 0.1% for Canada is 1/10 lower than expected. No back month revision.
Double miss. Would that be worse for Canada? Well, Jay, it depends on which spread you're talking about. But typically, money goes to higher rates, right? So the theory is, if yen pays 0 and New Zealand pays 2.5, that you'd rather have your money in New Zealand, all else being equal. And that always frustrates me in an academic question. All else being equal, blah 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 blah. Well, when the hell is anything equal? I don't know. All else. What do you mean all else being equal? Oh, so you're talking like a 210 spread, 510? Yeah, now you're talking yield curve analysis and stuff, and that's not something that I use in the currency markets. Probably has some impact, but typically what I'm looking at is yield differential mixed in with market sentiment or changes in trend, right? So, for example, Kiwi yen should be going up, but it's coming down only because there's a global scenario of deleveraging, and that's important. So I guess these 210 spreads will show whether people are buying short-term bonds or long-term bonds and so on and so forth, and whether they're worried on the short run versus the long run. But I'm looking at other more macro, um, indicators, if you will. And if the market was greedy, let's say, because there's only fearful and greedy, right? Greed and fear. In a normal market, everyone's greedy, everyone's in it to make money. Why do you save your money? To make money. You save your money. Well, you want to retire one day, right? So do you want your money to go up or go down? You want my money? You want your money to go up. So therefore you're greedy. So in that case, in a normal market, when when the market itself is greedy, right? They're willing to take additional risk so that they can capture additional reward. Then you probably would want to be long Kiwi yen. Yen is cheap to borrow, and Kiwi pays a lot more if you invest into it. Right now, however, um, we're not greedy, we are fearful. Okay. So I know a lot of people make a big deal on the you know the like the 210 spread, I think, is more common, but that's not something I personally focus on. I'm more of a, like I said, a macro, just whether money is going to a safe haven or flowing out to an opportunity. That's really what it comes down to. I'm sure that the 2-year, 10-year spread and the difference in yield will show that. It's like one person I saw, I've seen several times, uses 3 different indicators. I think they're all the same. I think they're all MACDs, and they might be all stochastics, because I can't remember. But I don't need 3. 1 is enough for me. And I say, well, why do you do it that way? Oh, well, it works for me this way. All right, so he uses 3 oscillators with 3 different settings, and I'm like, well, you could just look at the moving averages, and get the same thing. He's like, I know, it just works for me this way. Fine. So some people use the 10-year. Fine. So another way of looking at it is to say you could watch the Kiwi yen, knowing there's a spread in those yields, okay, and say, well, the theory is, just let's say fundamentally speaking, one would assume, right, at some point the Kiwi yen should go up. Otherwise, it'll get arbitraged down so that they're both paying 0, kind of thing, right? So at some point, if not this year, the next year, or the year after that, but at some point in a normal, healthy, functioning market, Kiwi yen should be going up. So you might just sit around waiting for that. Now, it could be weeks, probably be more than that. But when you do see it, you say, aha, now that's something I can believe in, that's something I understand. Money is flowing toward New Zealand. I want to be a part of that, so on and so forth. Well, Cream's the same thing, showing it differently. Like how about watching gold in terms of euro, not US dollars, and stuff like that. If that helps you do what you're supposed to do, then do it. Absolutely, totally nothing wrong with that, right? You should just find something that helps you make a decision, and then make that gall dang decision. Most amateurs have problems because they don't make decisions. Maybe it's because they don't know what to use or how to make the decision, but nobody makes the decision, right? I keep telling you, you should know what you want to do before you even sit down on your charts. So why is Euro USD going up is a big question these days. Okay, well, why should Euro be falling? Oh, well, because they're doing quantitative easing. Yeah, we talked about that last year. That's why it fell 3,000 pips. Now what? Why should it fall further? You see what I mean? Well, they're still doing quantitative easing. Yeah, we priced that in last year. What are you going to do this year? We did that for like 2 years. We dropped it from 140 almost to parity, right? Now what? It's been priced in. That was last year's trade. So where's more weakness going to come from? Well, they'll have to do something that we don't know right now, and that's do more quantitative easing. Good. Well, that's what we're waiting for. And if the ECB says we're going to do more quantitative easing, sell the hell out of the euro. Right? because supply goes up. It's only supply and demand. If supply goes up, you sell the euro. Not forever. All right. Should the dollar be strong? Yes, the dollar should be strong. But again, we've been playing that for 2 years. So why should it get stronger? Well, to make it stronger, you're going to have to raise interest rates. And here's another thing you must remember. You must remember these little details. The Fed has to signal that they will continue to raise interest rates. Because I know, because I've been through multiple Fed cycles, up and down, lowering interest rates, raising interest rates, lowering interest rates, raising interest rates. Been through it all before. And what'll happen is the dollar will continue to get stronger and stronger and stronger as long as we believe the trend for interest rates are up. And there could be a day when we're at 5.5%. And the Fed raises to 5.75%, but then says we're done. Even though they raised interest rates, the dollar will crash, and probably crash for 2 or 3 or 4 years straight. And then you'll say, oh, well, the spread between, the yen and the dollar. No, it's the fact that the policy is dead. Everything was priced in. Everyone knew the trend. Everyone was making money. And the train just derailed. Get off the train. Right? Right? If you're on the train and you look to the left and you see grass and you look to the right and you see blue sky, your train is probably crashed. You should probably get off the train. So that's what it's all about. So we're at this point where maybe our train isn't derailed, but we're at the station. You're like, dude, how come the trees aren't moving anymore? Well, people are getting off the train. A lot of people wanted to get off the station. They're done. They're right. So we need more quantitative easing to weaken the euro more. We need higher interest rates to strengthen the dollar more. Therefore, zoop, euro USD is going up. Now, a gambling man would say between now and September, I'll probably be heavy net short euro USD. Doesn't have to be today. How about the yen? We were short yen all last year, all the year before. Yet, in September, we talked about the yen being strong in January, and maybe maybe sort of hiccup in February, strong in March, right? So anyways, CAD having trouble making 12 pips, right? So we'll move on.com. So we're looking for a change, guys. We need like a oil to change. What's going to make oil change? OPEC, Saudi Arabia, something, something, something. By the way, while Janet Yellen was speaking yesterday, do you remember how I was supposed to be sleeping because I didn't sleep last night? Actually, 2 nights ago I didn't sleep much last night. 2 nights ago I didn't really sleep any. So after our session I was supposed to go to bed, right? I had a doctor's appointment, went and did that, came back, and then instead of going to bed, instead of watching Grandma Yellen, I attended BP's annual forecast webinar. I have the PowerPoint slides and everything. It's pretty, and by the way, fantastic presentation. The CEO of BP is what you would expect. Hi, I'm an old man. I like to do deals, right? Fine. Then they put the chief economist up, And man, the guy was smart, well spoken, looked like an economist, right? Well spoken nerd, which is good. And then he handled the entire like 2 hour Q&A on his own and just was awesome all the way through. He had very detailed answers. He had very smart answers, never got derailed. He even made people laugh several times. And there's, man, it was great. Here, let me open it. So anyways, that's what I was doing yesterday. And it comes down to, we're talking about supply and demand, right? And what is going to change? Where's the demand going to come from, right? The new demand. Where is, how are we going to draw down supplies when they're so big? And so these are the types of questions you need to be asking yourself, whether it's oil, but also if it's currencies. Where is the money coming from? Where is the money going to go to? Is it a positive thing? Like, is it a risk on thing? Um, you know, are people confident? Oops, sure, put it over there. Um, and try to get your head, tuned into some of these, you know, tuned into these trends because it will put you on the right trends. So, for example, what does Wayne do with his free time when I'm not sitting in front of my 18 screens doing webinars? I'm sitting in front of my screens listening to central bankers, listening to the chief economist of a super major oil producer, right? And getting, where's the growth going to come from? How do we get China and India involved? And you know, all this kind of stuff. It's fabulously interesting, but it's also ultimately where we make our money. Okay? You know what I mean? So yes, you're going to need to know MACD and stochastics and price action. You're going to need to know pivot points, but you really should master that in your first or second year, and then you should spend the next 200 years focusing on fundamentals because it should be pretty easy. Look, if the market's rising but yet prices decline to a support level, buy it. Now, do you need an ADX for that? Sure, get an ADX if that's what works for you. Stochastics? Yeah, sure, get a stochastics. How about a MACD? MACD is great. CCI? Use a CCI. Moving average crossovers are great. Use moving average. Do you like fibs? Do you like Elliott wave? Do you like pivot point? Honestly, I don't care. How about complete naked charts and just pure price action? Good. Make it happen, son. All of that should be easy, but understanding why trends are created, what changes trends, when the sentiment goes from greed to fear and from fear back to greed, and how does global stock market, like look what I've been showing you lately. We start by doing the Nikkei, and then we do the Euro 50, and then we do the DAX, and then we do the FTSE, then we do the S&P 500, then we look at gold, and then we look at oil, and then we look at commodity currencies, and then we look at funding currencies, and then we look at safe haven currencies. And all of a sudden, what you should realize someday is that they all are related. The one thing they have in common is money. And so ultimately, you should ask yourself, what are the most important things in the world when it comes to money? Energy is hugely related to money, right? Now, there's an interesting in here. Now that I'm talking about money and sort of GDP, there is a decoupling. I guess it's not even in here. That it used to be theory that the more an economy spends on energy, the more that it's likely to grow. But that's actually decoupled because we're becoming more efficient. So what they say is energy intensity is falling, yet GDP is rising, which is actually, it's a good thing, right? So if you look at the Ukraine, for example, the Ukraine still has Soviet factories for making toilet paper and toothpaste, and I don't know what, besides wheat, I don't know what else, what industry the Ukraine has, but it has industry. It does manufacture things, probably parts for nuclear submarines, but their factories are productive, but they're very energy intensive because it's old technology, right? Yet, if you look at a modern Japanese factory with robots running on nuclear power, even higher output, but for much less energy, right? So, anyways, so on and so forth. So, look, it's just money. So, I do spend time reading reports from central banks. I do spend time reading reports from government agencies. I do spend time reading reports from large industry like oil. In fact, as you know, I'm studying at Harvard, right? I do listen to testimony like Janet Yellen. I will pay attention to that. On the weekends, I listen to interviews with like fund managers and stuff, and what are the Wall Street guys going to do, and what's capturing their ideas. I spent a lot of time on this, but it is, and hopefully you agree, um, fascinating, right? Richard asks, when the hell do you fit it all in? Well, it helps that this is my full-time job, right? I do make a lot of sacrifices. I don't think you would call me a lazy person. I'm probably not balanced enough, right? I swear to you, uh, I was getting my hair cut recently, and like 4 times, the barber is like, relax. I am relaxed. No, relax. You're so tense. I can't even cut your hair. I'm like, I am relaxed, right? Yesterday, I'm at my doctor's appointment. They're drawing blood. They're like, dude, relax. No blood's coming out. The needle's in your vein. Just relax. I am relaxed. just relax. And all of a sudden, right? Then I take a deep breath. Okay. Oh, blood's flowing. Yeah, all right. I must relax there for a second. But anyways, yeah, I guess I love what I do. But what else did I do? You know, I played a game with my kids. We did some homework. Took my son to Science Olympiad practice. Got home, quickly ate dinner. Then son had to go to swim, to a swim practice. I had to study for school. I mentored someone in the evening. I traded like a son of a gun. Got a couple hours sleep. The dog's still sick. I had to take care of the dog. Wake up early. I mean, you just roll with it, man. It's not like this is the only thing in the world I do, but it's the only thing in the world I do well. Actually, that's not true, but I just love it. That's all. How do you fit it in? Yeah, and go to school, right? I don't know. I don't know. Like, I don't know. You just do it. How about that? Maybe that's it. It's like if you're at war, right? And how do you do it? Well, it's that or die, right? So just get into it. So I love it. Yeah, is the dog better? No, I don't think she is. So yeah, just love it, man. Just fall in love. Just relax. Just relax. Just relax. I might go outside today. I'm thinking about maybe going outside today, but who can afford that, right? So what can I say? I do a lot of work. and I'm very happy. I like the job. I like what's happening. The markets are moving, maybe not in a straight line, but you know, it's a start, I suppose, right? The pips are flowing. Life is fabulously interesting. We're in this trough, and it happens, guys, where there are times when it's a one-way street. And if you missed it, I'm sorry. But for about a year and a half, all we did was sell Euro USD. And then just even like 2 or 3 months ago, all you had to do is just sell pound dollar every day. I mean, it really wasn't hard, right? And now we're in this trough that's played out, and maybe in the next 3 to 6 months. And by the way, it can last that long. It does last that long. We can be in a trough for the next 3 to 6 months, and from now until September, it's basically up and down and sideways and down, and collapse and rally back up and then back into the right. And then maybe we have a change in trend where the yen is weak again, commodity currencies are strong again, oil's on its way to 55, not 25. And if you don't pay attention, one day you'll look back and say, holy crap, do you remember when USD yen was back at 110? How come I didn't buy it back then? Do you remember when Aussie USD was stuck at 70 for 6 months? How come I didn't get in then, right? So you have to slowly kind of pay attention and slowly add positions. And then when some of the positions are profitable, maybe make the decision to not get out. And always be ready with new information. For example, in the next 20 years, coal use is going to drop by 50%. So where's the money going to be in the next 20 years? Gas. So gas is going to boom and renewables are going to boom. How do I make money on that? I love sitting down with my children. How do we make money on this? It's a great question, right? Someone's got to move the gas. So if it was liquid natural gas, let's say from Trinidad, how do you get it to a refinery in Canada where they can turn it into fertilizer and other cracks, right? You got to liquefy it, put it on a ship. Wow. Are we going to need 300% more LNG shipping boating boats, right? Then maybe find the company that makes those. See how easy it is? And if we're gonna use natural gas a lot more for things like producing energy, well, there are byproducts to creating a natural gas that can be used for that. So maybe things like fertilizer prices are going to drop by 80% in the next 20 years. Is that going to be good for Potash Corporation of Saskatchewan? Is it going to be bad for Potash Corporation of Saskatchewan? I don't know. Start reading it up. But what's the world going to look like in 20 days, 20 months, 20 years? Start thinking about it. Start lining things up, right? Be prepared and trade. That's all it is. It's just money. That's the fun part. And hopefully you love that. Hopefully you love it. That the world is more than a 5A cross, more than a stochastic cross. Those things are important, but only if you have your head in the game, right? Doesn't matter how fast you can throw a baseball, if you can't hit the strike zone or control the way that it spins in the air, um, it's pointless, right? So you got to have your head in the game first, and then the rest just pulling the trigger. The pulling the trigger is the easy part. So, anyways, I've gone way too long. I apologize for that. Peace on earth. May the pips be with you. May your profits be above average. And I'll see you tomorrow at fxstreet.com. And you got a little central banking, commercial banking lecture today. That's a bonus. Right? I didn't get into the money supply thing. I didn't get into the velocity of money. But if you thought that was an interesting topic, you can do some research, follow up on that. You know what I mean? So take care, guys. The historical low oil price makes airlines profitable for a long time. Yeah, Debisa, that'll be fine. I read an article, Debisa, that they're so profitable now that they're going to start handing out free pretzels again. No joke. Oh, well, I guess I'll fly American Airlines again. I need the pretzels. Yeah, how about deliver my bags, right? Yeah, that'd be a better one. And how come they can't, you know, how come they can't build airplanes with bins large enough? And then how come, people in pajamas are so busy that they can't check their bags? They don't look busy. They don't look like they have anything important to do. Check the damn bag, right? But that's me. I'm just a grumpy old man. Cheers, guys.